One of the most common mistakes in construction accounting is thinking that revenues follows invoices or cash, when the IFRS 15 and accounting standard says that's not true. In long-term construction contracts, revenue is recognized on performance, no billing or collection. In this video, I'll walk through a real shopping mall project and how revenue is recognized over time, and how that leads to either a contract asset or a contract liability on the balance sheet. Let's go to the numbers. Here on the screen, we have the construction contract. This is a shopping mall project with a total contract value of $14 million, and the project runs over 3 years. At the beginning, total estimate cost is $30 million, and later during the project, the estimate is revised to $32 million. Everything in a percentage of completion method starts with cost. In year 1, the company incurs $6 million in construction costs. In year 2, it incurs $10 million more, bringing cumulative cost to $16 million. In year 3, it incurs $16 million, so total costs at completion are $32 million. These cumulative costs are what we use to measure the progress. Now we calculate percentage of completion. The formula is simple. Cumulative cost divided by total estimate cost. In year 1, 6 divided by 30 gives us 20% completion. In year 2, after revising the estimate, 60 divided by 32 gives us 50% completion. In year 3, cumulative cost equal total estimate cost, so the project is 100% complete. We have the percentage. Revenue is straightforward. We apply the percentage to 14 million contract value. At 20% revenue today is $8 million. At 50% revenue today is $20 million. Revenue is recognized incrementally, not all at once. In 1 year, revenue recognized is $8 million. In year 2, revenue recognized is $12 million. Expenses are the actual cost incurred each year. That gives us profits of $2 million in year 1, $2 million in year 2, $4 million in year 3. Over the entire project, total profit is $8 million, which matches the difference between total revenue and total cost. Now let's talk about construction in progress, or CIP. CIP accumulates cost and recognize profit while the project is ongoing. It represents the value of the work performed to date. Under IFRS 15 and Accounting Standard Codification 606, construction contracts are presented on the balance sheet based on the net contract position. The key formula is contract asset or contract liability equals CIP minus billings. If CIP is higher than billings, the company has done more work than has it billed. That creates a contract asset, sometimes called unbilled revenue. Let's go with accounting. In year 1, the company incurred $6 million in construction costs. These costs are debited to construction in progress and credited to account payable. Based on the percentage of completion, the company also recognizes $2 million of profit, which is added to CIP. As a result, CIP ends year 1 with a balance of $8 million. During the year, the company bills the customers $5 million. The $5 million bill is recorded in billings on CIP, which is a contract asset that offsets CIP and creates account receivable. $4 million is collected in cash, and $1 million remains outstanding. On the income statement of the year 1, Revenue is $8 million. Expenses are $2 million. In year 2, CIP starts with an opening balance of $8 million. During the year, the company incurs $10 million of additional costs and recognizes $2 million of profit. This increases CIP to $20 million at year end. The new total cost increases account payable, bringing total payable related to project to $16 million. During the year, the company bills $8 million and collects $6 million in cash, leaving $3 million outstanding. On the income statement for year 2, revenue is $12 million and expenses are $10 million. Profit is $2 million. In year 3, the project is completed. CIP begins the year at $20 million. The company incurs $16 million of final costs and recognizes $4 million of profit. This brings total CIP to $14 million, equal to full contract value. Because the project is complete, CIP and billings on CIP are closed against each other, removing both accounts from the balance sheet. During the year, the company bills $27 million and collects $13 million in cash, leaving account receivables in zero. On the income statement for the year 3, revenue is $20 million, expenses are $16 million, profit is $4 million. If we look at the entire project, total revenue $40 million, total cost $32 million, and total profit $8 million. And that profit is recognized gradually in line with performance. This is the essence of the percentage of completion. Revenue follows the performance, CIP tracks the work performed, billings track invoicing, and the balance sheet reflects the net economic position of the contract.